All right, in this video, what we're gonna do is we're gonna cover an apartment deal that went full cycle. And in this deal, it went 2.5 years and we were able to get all of our passive investors an 88% return on investment in 2.5 years, which is pretty awesome. It way outperforms the stock market. So that's what we're gonna dig into in this particular video. I'm gonna show you what the deal looked like when we bought it, the strategies we used, and if you had invested $100,000, how much money you would have made in that investment in 2.5 years. So let's get started. So let's talk about this case study, this property that we got, and how we achieved an 88% return on investment in 2.5 years in a multifamily investment deal. First, though, I want to share a couple of testimonials with you. The first one is from Derek, and Derek says that Stephen Lee Thomas Capital provides an excellent service, be it on an investment level or personal level, and they do a great job making sure everything is explained clearly, no matter how complex the opportunity. He also is very appreciative of the risk-based approach they take to ensure that the projections provided are realistic and have a safety margin built in. He says, I truly believe they have a great future ahead. He's one of our investors. We also have Ting Ting, and she says we're very knowledgeable about our investments, and she feels very confident in her investments with us, and she'd highly recommend the Stephen Lee Thomas Capital as a team to invest with. And then we also have Anik Singhal, who's invested with us. You may have even seen him on social media. And he just wanted to say a shout out to the entire team for achieving above average returns, stellar communications, and the ease of the entire investment process. And these are just 3 examples of people who have invested with us and have nothing but good things to say. I am talking about financial projections today. So this is just a disclaimer that these are not always going to be the case. There is risk involved in these. They are investments, but we always do everything we can to mitigate these risks and provide education to help you make the best investment decision for yourself. This is our portfolio as principals. I wanted to share with you that this is not our first time doing business. We've been doing this for a while. We've invested in several very large apartment complexes. You can see here, 186, 184, 200 units. And we've been able to, on average, between 3 to 5 years, and sometimes sooner, like the deal we're going to talk about today, been able to fully implement the business plan and give our investors back a pretty good return that will outperform the stock market. So let's get into the case study here, how we achieved 88% return in 2.5 years by investing in a multifamily deal. So a little bit about me, if you don't know me. I was busy working a corporate job, climbing the corporate ladder, raising my family, but it was really burning me out and I wanted more freedom. And to do that, I was seeking investment. Could I invest in that could give me cash flow and grow my wealth? And so I set out on this journey to educate myself. I went to school. I got a degree in a business degree in an entrepreneurship, with an emphasis in marketing, which was all well and good, but it wasn't very practical for what I needed to do to invest and grow my wealth. Just rather than relying on my started heavily investing in self-education and joined multifamily real estate groups, which gave me the fundamentals that I needed to move forward. And I actually started as a multifamily investor in 2017, but when I did, I had already joined a syndication group for the education piece, but I was very busy. So I actually started out as a passive investor, which was a fantastic way to earn mailbox money while I was learning about how to do this and go full time and start building those relationships with potential partners in the future that eventually became my partners. And now that I'm doing this, I really understand the value that it can bring to others. And my goal here, why I actually left my W-2 job and went into apartment investing full time, is because I want to help other people achieve financial freedom, because with financial freedom, we gain time freedom. And time freedom is what we're all looking for, so we can live the lifestyle that we want to live. So who is passive investing for real estate, specifically multifamily investing? So This is for you if you're seeking alternative investments that's going to be more predictable and secure than the stock market. We like to joke around and call it the stock market casino. If you want to earn above average returns compared to the stock market, where most of us are educated to invest our money and where we're told to put our money with people that we don't know and have little to no control over what's going on with those investments. It's also for you if you want to invest in a hard asset that you can actually visit. And if you want to see your investment making an impact on communities. If you also, it's a great opportunity if you want to learn this business and do what we do. Like I said, for me, I started out as a passive investor, but I knew where I wanted to go. So it was a great way to earn money while I was learning. And lastly, as I mentioned, as someone who has a deep desire for freedom, not only financial freedom, but what we're all striving for is that time freedom. So the way we do this with all of our investments is there's 4 pillars that we have for all of our apartment deals. We call those the 4 pillars of apartment investing. And we ask ourselves, do our deals follow all 4 pillars? And those pillars are, is it a strong market? Are there strong market fundamentals there? Meaning, is it a business-friendly location? Is it a landlord-friendly location? Are jobs being created? Are rents going to be on the rise? Because if it's a good market, even if it's an okay property in a good market, when there's market cycles, the property will be able to withstand the fluctuations in the deal, and you can still, strive to do our best to get the great returns for our investment. Where we can add value to the property, but proven value add, meaning we're not trying to be a cowboy. We're not trying to do something that the rest of the market hasn't done. We want to add value to the property where we can see it's already been proven in the market. That's the most secure way to make sure that when we implement the business plan that we can achieve those results. Third bullet point, conservative, data-driven underwriting. We don't make emotional decisions. We let the data do the talking, and we have a very detailed underwriting process, a very collaborative process where we analyze these deals and we do property tours and market surveys. We look at all the financials, the rent rolls. We have a very detailed process we go through on our underwriting, and if the numbers make sense, that's when we're going to start submitting offers. And then the last thing is, do you have experienced, committed asset management team? The experience a team can make or break a deal. I can personally attest to this on, being through markets where they're very tough. If it wasn't for a very strong, experienced team, there's a potential for even losing the deals. But when the team comes together with the experience, it really drives things forward. So let's dig into this particular property. So this is Crossings 820. It's a 418 unit apartment complex located in Fort Worth, actually in Texas, formerly known as Fountains Corner. All right, so we dig down into this property a little bit more, and what I want to show you, it's a 418 unit property. It was a value add property. So you have 2 different ways you can get into these deals and force appreciation. One's value add, one's yield. And value add is where you improve the property, and as a result of improving the property, you're able to generate more income. And that would be doing, for example, unit renovations and charging more for those renovated units. Yield would be there's poor operations, meaning they have a low occupancy, low collections, high expenses, and you go in and you try to tweak those things. So this was a value add deal, purchased November of 2019. It was purchased for $37.62 million, $37,620,000. So it was a very large purchase. Purchased at $90,000 a door, and the purchase cap rate was 5.2%. The projected returns on this deal was actually 79% over 5 years. So like I mentioned, we'd like to do conservative underwriting so that we can ensure that the returns are realistic. And we like to under promise and over deliver where we can, but we need to be realistic about what we can provide. And if the market supports better than that, then it's a win-win for everybody. Total returns was 10% cash on cash with an IRR. This is kind of a complicated formula, but it's your internal rate of return. and that was a 14.5% on this deal. So when we dig into this deal a little bit more, the case study, we're going to look at it from the 4 pillars. And so number 1 here is its growth market. So Fort Worth is part of the Dallas-Fort Worth Metroplex, and it is projected to be one of the fastest growing metros in the United States for I think the next 10 years, and probably likely, further on than that. And because it's a business-friendly state and a landlord-friendly state, Texas is a great place to invest. Not only that, more specifically located off of I-20 near TCU, next to a mall and a parkway. And in that area, there is population growth, job growth, solid school ratings, and a good median household income. And those are all important factors when you're looking at a deal. Now, what was the value add part of this deal? Well, we wanted to rebrand this property to actually reposition it. So to do that, we knew that we were going to have to spend CapEx dollars to clean up the exterior and a lot of the deferred maintenance. The value add was through interior renovations, and we knew going in that if we were to renovate the units, that we would be able to achieve somewhere between $100 to $250 rent increase by renovating those units. So like I mentioned before, we like to do something where it's already proven in the market and not something that we hope is going to work, and that way we can ensure it's going to be a good investment for our investors. The other part of this, which is important, is meat on the bone. And meat on the bone means when you go to sell the property, you want to implement their business plan, but leave some opportunity for the next buyer. Because if they can see that you've already done some work and there's a proven way to add value, it makes it a lot easier for someone to come in and sell it. So part of the value add strategy is also when we think about the exit strategy. All right, so then we get into pillars number 3 and 4, and we're going to spend a little bit more time in underwriting because it's where so much takes place when we do these deals. So from an underwriting perspective, we really like to look at the pro forma rents and the average price per square foot. We knew that the comps were renting for $1.21 per square foot. And Fountains, when we got it, at purchase was at 91 cents per square foot. So we did our underwriting at, between 99 cents and 97 cents per square foot. But we were able to, achieve that up to $1.21. So we were as conservative as we could be, meaning our pro forma, we didn't run it all the way up to $1.21. We ran it up, to 99 cents or 97 per square foot. Now, the cap rate for the underwriting, we went in at 7.25% cap rate, but we're able to sell it at with the underwriting at 7.25%, but the sale was actually at 5.25%. The other income portion of underwriting, we had projected that to be right around $600,000 to $598,000, and you'll see it was $603,000. So very, very, very close. We're able to come in a little bit above that, and the rental income projected. We were shooting for 4.5 million, but we're a little bit shy of 4.4 million. And the reason for that is because, like I mentioned, we were underwriting. We didn't want to go all the way up to $1.21 per square foot. We underwrote to 99 cents per square foot. We actually implemented at 97 cents per square foot. But that enabled us to keep the occupancy high and the demand high, and also leave meat on the bone for the next purchaser to come in. And then lastly, the last piece here is the asset management portion. And we can't overlook this because that's where the majority of the work happens, is after you acquire the property and implement the business plan. So from an asset management perspective, we went into this with the experience of the time with the principles of over 3,000 doors. And what we do on all these deals, there's a team of us. We very clearly have roles and responsibilities, and everybody's assigned a role based on their skill set and experience. So together we work on this as a team, and we're able to accomplish a lot more because we come in as a team. So because we followed those 4 pillars, knowing the market and understanding our risk and our underwriting and asset management, we were able to renovate and sell this property in 2.5 years. So what does that look like? The hold period, sold it in May of 2022, 2.5 years of ownership. Total returns projected at 79%, actually was able to hit 88, 89% there. The cash on cash for this deal is basically your cash flow projected at 10%. It's actually at 9%, a little bit lower, but that's because we would have held it for the full 5 years. The cash flow would have gone up, and generally goes up year over year. The internal rate of return, IRR, was projected at 14.56%. It was actually at 32.5%, which far outperforms anything you've got going on in the stock market. So had you invested with $100,000, what would that have looked like for you? Well, there's two components. There's a cash flow or distribution component, and then there's a capital gain event, or the money that you make when the deal goes full cycle and sells. So here's how it would have been split up. Year one, there was a 9% distribution. If you invested $100,000, you would have made $9,000 in distributions. Year two, same thing, $9,000 in distributions. And you got a half a year into the third year, and so that 9% would have been $4,500. So you would have made this much money just coming into your checking account or whatever bank account by not doing anything. And then when we sold the property, you'd get your $100,000 back, plus you'd get $66,500 on top of that. So when you add up this money and this, that's where you get your 88% return on investment in 2.5 years. So pretty good deal for all of our passive investors, because they didn't have to do anything other than invest, and they made a killer return on these investments. So with that, what I want to share with you is why right now the time to invest in apartments. Well, if you take a look at our track record, right, we have proven investment experience, we have those core values, and we have our solid pillars investment strategy, which makes, we always strive to do the best we can with our investments. So I will tell you these things. The time to start investing, not only, your dollars, but in yourself, is always right now. It was yesterday was the best time, but today is the second best time. And the people who have been most successful in this journey, they just took the action and they just made the commitment, and they went forward with it. The reason why I share that is because a lot of people will invest, only 50,000, or I'm only got 20,000, maybe 100,000. But if you really want to generate truly passive income, you need to think of it like how much money you have invested in the stock market, your 401k. Your goal is to have millions of dollars there. But if you could have millions of dollars invested in apartments, you could make much more money than you would as if you had it just parked in, your 401k. So what you get with that is there's more stability in apartments. You don't generally have the ups and downs like the stock market, especially not from one day to the next. Something to consider is that there is a limited supply of housing, and building has slowed down significantly, and it's expected to stay that way for the foreseeable future. There is going to be a continued demand for rentals in the United States for the foreseeable future. And the reality of it is, due to some of the banking issues that we've seen over the last few years, is people don't want to have all their money in the banks or the stocks. And even my wife said the other day, I don't like having all this money sitting there. We need to do something with it. So this is an opportunity to help with that and get your money invested into a proven asset that's tangible, that's going to grow your wealth and has tax benefits for you. And there's going to be a huge influx of money going into apartments over the next 4 to 5 years, which is going to drive demand, because we've gone through a market cycle and we're about at the bottom of that market cycle. So money's going to start coming back in, which is going to drive values up significantly in real estate, because real estate is on sale right now between 25 and 40%. And it's definitely a buyer's market. I'm not saying there's a lot of deals out there to buy, but when it comes to negotiating, it is a buyer's market. So with that, how do you get involved with Stephen Lee Thomas Capital, and how would you go about, making investment in one of these deals in the future? So it's pretty easy to do. All you need to do is schedule a one-on-one call. And what we're going to do in that call is we're going to see where you're at, see what your goals are, see what your obstacles are, what's working well for you, what hasn't. And then if I feel like you're a good fit for this type of investment, then I'll share with you exactly, if you were to invest your money with us, what those returns would look like in a best case, worst case, and most likely scenario, so that you can plan accordingly. From there, you give us a soft commitment, and it gets you signed up to join our investor club. And then that way, as deals come up, we make them available you can get access to those. And what you really need to start doing is thinking about what is your investment amount that you're going to do, and get those funds ready to get into an investment. So with that, how are you going to get a hold of me? If you're watching this on the replay, then this is going to be recorded somewhere below this video. There's going to be a link below to schedule a call. Go ahead and click that link, fill out the questions, and you'll get a one-on-one call with me, and we'll go through this together, and I'll help you out there. So with that, I just want to thank you for taking the time to watch this, and I hope it's been informative and you get some insights into what an actual case study is like when we buy these apartment complexes, and the things we look at, and the other things we do. If you still are looking for more information, then check in the other videos, and there's another video that walks you through an apartment investing overview. It's more detailed. It goes into other alternative investments. It shows you a comparison over 20 years if you invested in the stock market versus in apartments, and it also gives you a much more detailed evaluation of how we do our underwriting and finding these deals, and how we take them full cycle. So like I said, go ahead and look in the other videos here. So as always, feel free to get a hold of me. You can find me on LinkedIn at Stephen Lee Thomas, or on Instagram at Stephen Lee Thomas, or shoot an email to info@Stephen Lee Thomas. Either me or someone from my team will reach out to you, and we'll get a call set up. Thanks so much.